Can I welcome Will Holland, the Chief Financial Officer of Fastnet Oil and Gas.
Thanks, Mike. Just to start off with, this presentation is quite busy, so I'm going to just highlight various parts of it. It is available on our website, and there will be some hard copies outside if you want to pick one up. But please try not to sit there and read through the slides. There is quite a lot of good information on there, which I encourage you to read at your leisure. But I'll just highlight the various bits which I think are important. There's the usual disclaimer. What I'm going to talk about today is a bit of a company overview, then talk about our assets. To start off with, some of you may have read in the press that we were considering changing our business to something like a medical technology business. We are absolutely an oil and gas business. We are only going to be an oil and gas business, and that is our strategy moving forward. I've been oil and gas my entire career. You'll look at the rest of the board and you see a lot of them are in oil and gas as well. But yeah, the speculation in the Wall Street Journal a few weekends ago, I can assure you we're an oil and gas business. So let me just point out a couple of key things. We have assets in Morocco and Ireland, which I'll go through in a minute. But the key thing on this slide is we've got $18 million of cash as of the end of November. Our running costs here are showing at $3.3 million a year. That's actually crept up over the past few months. We are, as a board, very clear that we need to bring those G&A costs down, and we're going to try and get them down to less than 2.5, hopefully towards $2 million a year. The oil and gas sector at the moment is going through a bit of a turbulent time, and we're very focused on cost control. The cash is a very important part of our balance sheet, and we want to preserve it as much as we can. So if we just look at our asset portfolio at the moment, we're based in Morocco and the Celtic Sea. So in Morocco, we've got an option on an asset onshore Morocco. We have an asset offshore Morocco where we've partnered with BP and Cosmos and a company called SK Innovation. And then we have a package of assets in the Celtic Sea. So what I'll do is I'll just sort of walk through these assets and explain where we are with each of them and what our strategy is for each one of those assets. But before I do that, let's just talk a little bit about the business model. We're set up as a company not to be a full cycle oil and gas company. So we don't want to go everything from acquiring, exploring, developing, full production, abandonment. That's many different skills and disciplines required to go through that full cycle. We are also a small team, and we are specialists more in the exploration phase of the oil and gas business. So our model is to pick up assets at a relatively early stage. Do as much, and when I say early stage, I'm talking about early from a exploration development cycle. Do as much work on it as we can ourselves, but without spending too much money, and then look to farm down for a carry. And then there'll be some sort of value catalyst, normally which will involve drilling. On the back of drilling, if you're successful, we would look to sell the asset. And then the money which we'd make from selling it, we would then distribute back to shareholders. Now, there was a point that was made earlier on about the oil and gas business and the fact that exploration is out of favour. That's certainly one of the consequences of the current oil price. I actually recently wrote an article for Shares Magazine. I'm not sure when it's going to be published. I know it hasn't been published yet, but it'll be next week or the week after, I believe. But anyway, it was talking all about how do you develop a small business in this particular environment. Because we are reliant upon majors and larger companies farming into our assets to hopefully carry us and take the projects forwards. Now, when you look at a major's cash flow, you say, well, they've got a product, hydrocarbons, and they sell it at a price. Most of that product is oil, and the oil price has come off 40-odd% in the past 3 or 4 months. So you say, well, what can they do? Cutting costs is difficult quickly. They can over a longer period, bring down costs from the service companies, but typically those costs are very sticky. So your bottom line, your free cash flow gets hit very, very quickly. So a lot of the majors are looking now, they're looking at their 12 to 18 month budgets, and they go, actually the amount of cash that I've got to spend has suddenly reduced significantly over the last 3 months. So where can they cut it? Most of the majors don't want to cut their dividend, so they don't really want to do that. They can't cut costs very easily. They can over a longer period of time, but as I said, costs are sticky. So the thing which tends to get hit is exploration. However, what all oil and gas companies have to do to take a longer term view is to continue to find oil. Because once they've found oil and developed it, the field starts to deplete. Yes, there are secondary oil recovery techniques you can do, such as water flooding and infill drilling, etc. But eventually they're going to have to find new fields. So they have to explore. And one of the key metrics that all of the big oil and gas companies get judged by is their reserves replacement ratios. So they are looking to replace their reserves. So that's an important aspect, and I'll touch on that later on when I talk about our assets in the Celtic Sea. So exploration is not going to stop. It's going to be reduced, but what's going to happen is that the oil and gas, the majors are looking for more sensible ways to spend their money. They lower risk exploration and getting more oil for their risk dollar. Anyway, we think that our assets lend themselves quite well to that type of drilling approach, and I'll talk about that. Now, we have completed this cycle with our Fumasaka asset, where we acquired it. We farmed down to SK Innovation. We drilled a well at the first half of this year. Unfortunately, it wasn't a commercial success. However, we did find oil, but not commercial quantities. I'll talk about that in a minute. So the monetization option there was not available. But we've proved that we can go all the way down to the explore. Obviously, we can't change the rocks. The rocks are the rocks. And if we're successful, great. But it's more of a case of trying to put as many of those on the table as we can. So how do we execute the strategy? Some of you who've followed the company will notice there's been a few board changes. Carol Law has come in now as she's been part of the board for a number of years. She's now the Chief Executive Officer of the company. She's got a lot of experience with Anadarko predominantly. She was involved in a lot of the discoveries off Mozambique. A lot of experience in farming into and farming out of assets. She is a geologist, but she's a very commercial geologist. So she's very aware of sort of what is required to move assets forward, and not only technically, but on a commercial basis as well. Cathal Friel was executive chairman. He's now non-executive chairman. Cathal has got a tremendous amount of experience in building companies. He's a very entrepreneurial individual. He's built his own business in Ireland and sold it for 100 million euros. I'm oil and gas through and through. I started off as a frack engineer before most people knew what fracking was, and ended up as a bank investing in small cap oil and gas companies, and now I'm in one myself. And then our non-executive directors, Michael Elliston, he has been involved in setting up a very large amount of companies on AIM, and is very experienced in driving value. He's one of the founder of a company called ASOS, which is a online retailer, which has done tremendously well. And then Michael Nolan is former finance director of Cove Energy. Some of you will have heard of that company. They did very well off the east coast of Africa. So that's the board. And I think we've got the right skills that we need to execute on our strategy and actually move our assets forwards. So now I'll just talk briefly about the assets individually. First, I'll talk about Morocco. We went into Morocco because it is a very fiscally attractive area to go into. I will point out that the gas prices in Morocco have held up very well. So while oil has been slipping and continues to slip, dropped below $60 for Brent today, in Algeria, the price of gas has held up very, very well. So this is the pipeline that goes through Algeria up into Spain and into Europe. and that's the price that they're getting there. And then also there's a very strong local market. Morocco imports 95% of its energy requirement, and the government is very motivated to find its own supply of gas to develop its own power. The fiscal terms are very good, 25% state participation and a low royalty for gas, only 5%, and a low royalty for oil at 10%. And very importantly, you get a 10-year tax holiday upon a commercial discovery. It does mean that the hydrocarbons in Morocco are much more valuable than the equivalent volume of hydrocarbons in other parts of the world. One of the reasons that we're there. So we have our onshore asset, Tendrara. This is actually an appraisal asset rather than an exploration asset. There has been a well drilled on here. There's been a number of wells drilled in the area. We've got one well on this structure, the TE5 structure, which I'll talk about in a minute. It's 120 kilometres away from this pipeline, which is the Maghreb pipeline I just mentioned. But that's not the only monetisation option. The other monetisation option is to build a power plant on our block and then connect into the grid, which is just down to the south of it. It gives us choices, and obviously choice is a good thing. I'll talk about that a little bit more when I go into the detail of the asset. A couple of slides here about the Maghreb pipeline. I'm not going to dwell on those. And this is a lot of information about the asset itself. I will point out, now this is an option. And some of you that follow the company well will know that this option expires at the end of this year. So why am I talking about it? You say, well, if you don't exercise the option, you lose it. Not necessarily. Our strategy has always been that if we can't bring a partner into this asset, then we're not going to take it forward. We're not going to drill the asset. We've been trying to farm this out for the last 6 months, and we've made significant progress on that. However, we're not quite there yet. We are currently in the process of talking to our partner, OGIF, who holds 75% of this asset. This 25% is once we exercise our option, and we would then take 50%. With the amount of progress that we've made with this asset, we are strongly of the opinion that they will extend the option and will give us more time to execute a farm-in partner, which will then bring this asset forward. If we walk away from it, they're basically back to square one. But we hope to be in the new year to be able to announce that we've successfully extended that option. So if we talk a little bit about the asset itself, as I said, it's a large area, 14,500 square kilometres. There have been 7 wells drilled in the area, 6 of which discovered gas. 2 which were tested. This one here, it tested, but the pressure dropped off quite quickly, showing that it was quite a small accumulation of gas, or compartmentalised accumulation of gas. The structure I'm going to talk about is this T5 structure. Now this is a large structure. There was a well drilled on it just here. That well flowed for 3 months, and it flowed at 1.5 million standard cubic feet a day, and there was no pressure decline. That means that the connected volume around the well bore was actually very good. We've got if you do the analysis of the reservoir engineering, we've got 35 BCF connected volume there. The issue is that the rate is not high enough to get commercial volumes. You need to have a high enough rate to cover your costs to make it to give you a positive NPV on the assets. The analysis that we have done indicates that we need at least 4 million standard cubic feet a day. So why do we think that we can get over 4 million standard cubic feet a day for a well that only tested 1.5 million standard cubic feet per day? Without going into too much of the details, the 2 key factors are there was 22 metres of net pay that was logged. Only 10 metres of that was actually perforated because there was some junk that got left in the hole inadvertently by the previous operator. So they couldn't perforate across the whole interval. They only perforated 11 metres of pay. The only other factor was that they could not remove all of the completion fluids out of the well. So they had hydrostatic fluid left in the well, which acted as a pressure onto the formation. So they couldn't flow it properly. If you drilled the well properly, and our analysis, and this is validated by third-party engineers, we believe we could get over 9 million standard cubic feet a day. With 9 million standard cubic feet a day, assuming a 10 BCF EUR per well, you get very, very strong economics. So we think that it's an excellent field. We think if we can extend the option, which, as I said, we're looking to do early in the new year, we have a number of people interested in farming into it. We think who won't execute on an option which is about to expire, so we need to get the option extended. So then hopefully we can take it forward in the new year. This is talking about an analog field called the Mescala. I encourage you to read that by yourself. This is analog to our field, and this is the unconventional play. There's a large unconventional play in our block. We don't consider that in our analysis at all. You need to develop the conventional before this comes into play. Offshore Morocco, I said that we drilled a well with BP and Cosmos earlier in the year. So this is the block. The well was drilled just here. The farm-in that we got from SK was a 2-well farm-in. This was the first well. The data from this well will be incorporated along with the data from a number of other wells, including Janelle's well, which was recently tested. Pura Vida have just spudded a well up there. We've got some data from the Fundra well here. We're incorporating all of that into our model to determine where we drill next. But looking at the original well, this is what the pre-drill was. As you can see, this is a salt diaper here. We thought it was quite steeply dipping. In fact, it was relatively low relief, and we encountered salt much earlier than we thought. But we did find live oil. This is the cores from the well. So we encountered live oil, but it was right at the feather edge. There was hardly any reservoir there, and it was very fine-grained. So no reservoir development, but still live oil, proving working petroleum system, trap, seal, source, migration, etc. We're looking to possibly go down dip to see if the reservoir develops down dip. That's still being determined by the partners, and that news should hopefully come out next year as well. So moving on very quickly, I notice I've only got 4 minutes left. Offshore Ireland. So this is our acreage offshore Ireland. You'll see that we've got large interests in all of it, and we held a workshop in the beginning of May to try and farm this down. We were making very good progress, and up until about a month ago, I'm actually quoted as saying a couple of times that I thought we would close a deal before the end of the year. That's not going to happen. The majors are, without doubt, taking stock. Oil price is still sliding. Where it's going to hit, I don't know. We shall see. I think the majors want to get confidence that the oil price has hit a bottom, so they can then budget properly. But I did mention earlier on about the assets and why I thought it was actually still an attractive asset for a major to look at. And what I'm going to focus in on is Deep Kinsale. So this is Deep Kinsale here. We shot 3D seismic over this last year. It cost us $20 million, but it was an essential thing for us to do to prove that there was not compartmentalization risk. This is a section of the 3D underneath Kinsale. You can see that there's this east-west faulting, but what's important is there's not north-south faulting. So we do not believe that there is a compartmentalization issue with our field. Now, obviously, when you have a compartmentalized field, it means that the field is more broken up, and you need more wells to extract the oil than you would do normally, so your capex is higher, so your project economics are worse. We don't think we have that problem. There are areas in the north, in the Celtic Sea, which does have that problem, but this 3D, we believe, goes a tremendous way to prove that it's not an issue with us. So if we go back to it, that was on the upper Purbeck here. So what do we know about this? We know that there's a very good source rock. This source rock here has filled the Kinsale gas field, which has produced 1.7 TCF of gas. It's the same horizon as the Barry Row field, which is just here. That's Barry Row. It's on the same horizon as Barry Row. Wrong way. There's been a well that's been drilled just here that logged 220 feet of pay. So we've got a very good idea of what the oil quality is going to be. We know that there's probably not going to be compartmentalization. We know that there's a very good source rock. And we also know that the P50 estimate for these reserves is 270 million barrels. And a well in here is going to cost us about $35 million. So if you compare that to the well that we drilled offshore Morocco we were chasing a 360 million barrel target, and it cost us $125 million to drill. It didn't cost us, it would cost the gross cost, $125 million. So you say, okay, what's the cost? And I worked this out, I should have had it on the tip of my tongue, but I did work it out earlier on, of the risk volume. So you're basically paying, you're getting 2.9 barrels for every risk dollar offshore Morocco, compared to offshore Ireland, you're getting just under 7 barrels per risk dollar. So that's obviously assuming like with like. Obviously, the risks are different. It's a different geological setting. But the point is, you're getting a lot more for your dollar here than you are in West Africa. So $35 million versus $125 million for just a smaller target in an area where we know a lot about the source rock. We know a lot about the reservoir because we've drilled wells very close to it. We've got good 3D seismic over it, so we know there's not compartmentalization. So from a major looking at this asset, saying actually this is a better risk to take than going deep water West Africa or offshore Greenland or off in the Arctic, where you're going to spend 150 up to $250 million on a well, as opposed to a similar size target for $35 million. Hence, we think the Celtic Sea is an attractive area. We just have to see where the majors end up. They've got to keep on drilling to keep replacing their reserves. We also have this Mizzen. This is a gas opportunity, and this just shows how we can monetize this gas opportunity. There's very few wells drilled in this area, but we've got some good seismic over it. And this is a bright spot showing it's 3D seismic, showing that it's good. It's a good gas potential. So what are the share price catalysts? Well, the first thing is to get this extension on the option for Tendrara. We're hoping hopefully to get that at the beginning of the year. We will continue our discussions with Tendrara. We'll continue our Celtic Sea discussions with the people that we're talking to at the moment, and we'll be looking to announce the next well, which will be carried on in Fumasaka. And then obviously there's business development opportunities. With $18 million of cash in the bank, we're not going away. A lot of small cap E&P companies are suffering. It's very difficult to raise money in the current market, and we don't have to do that. So we're in a strong position. Then there are some appendices which I won't go through. Thank you.
Questions? Anybody? Gentleman just here. Pete, just there.
Hi, Will.
Hello.
Some days ago, I read about, I think, Lansdowne. They've actually got someone to, Petronas have actually farmed into the Middleton field that they've got there.
Yep.
Then I also read that, the Barrio one that they've actually got the German company actually coming to assist in producing from there. Are these two companies not part of the people you've been speaking to, or why is it that, we haven't had anything more regarding the sort of farm out process you've got going on in the Celtic Sea?
Well, it's a very good point about Lansdowne and Petronas. So Petronas farmed into Lansdowne, which is a block very close to ours, and they've committed to bringing a rig into the area at the end of 2015, early 2016. Now Petronas own the Kinsale gas field, which is the gas field which sits above our deep Kinsale asset. That is practically depleted. It's 98% depleted now. And they've got infrastructure sitting on top of that. They've got two platforms. So they're looking to delay their P&A obligations for that platform as much as possible. So they're more chasing the gas play. The Lansdowne opportunity is a different play type to our opportunity. And Petronas are already our partners in our deep Kinsale asset. So they're not interested in farming. We took the we farmed into them effectively, and now we're looking to farm down. So they aren't someone who we could look at bringing in as well, because they're already our partner. However, what it does mean by Lansdowne and Petronas bringing a rig in is the Celtic Sea is a little bit remote, and it is hard from a mobilisation standpoint. It does cost a bit of money to bring a rig in. So knowing that there's a rig in the area at the end of 2015, early 2016, does change the optics of a deal for anyone looking to farm into our assets, because they now know that there's going to be a rig in the area, and they now know that they're not going to have to pay for the mobilisation and demobilisation costs 100%. They can share that cost with somebody else. Providence still need to find a farming partner. The deal you're talking about, I'm not actually familiar with, I'm afraid, but they are still looking to find a farming partner to actually take that risk from them. Hopefully they will announce something at some point soon, because obviously if they do that, then it's good for us as well. I mean, the more activity we have in the area, the better it is for us.
And then, sorry, last time Paul came here, he did mention, I think, is it Guinel drilling Sidi Musa? Mm-hmm. And he said you've got a similar prospect,
yes,
on the block you've got in Fumasaka.
We do.
So I read something which said they found a reservoir,
yep,
there. Mm-hmm. And I think something went wrong with it. Mm-hmm. Has there been any further developments on that block? I mean, given that you've got something similar on yours, which...
Yeah. Well, I mean, we don't have any in-depth data on that, apart from what we've read in the press and what our own knowledge is around about that asset. But that was a carbonate play. The majority of our block is actually a Cretaceous clastics play. However, we do have a carbonate prospect on the far east of our block. Now, it's very encouraging that they found oil. There's no way that Guinel would have tested that well if they didn't think there was a good chance that they would get a flow test out of it. Unfortunately, they took a lot of losses when they're drilling. The thing about carbonates is they can be very vuggy, and as you drill through them, you can lose your drilling fluid into the formation. So they took a lot of losses into the formation. So they put a lot of mud, which has got polymers and barite, all the sort of thing which basically block up the permeability of the reservoir. And when they came to test it, they couldn't get commercial rates out of it. Now, that doesn't mean that you can't drill this and actually drill it with a mud or a system which will prevent you from having those losses and allow you to flow the oil. And in the Guinel press release, they did say that they thought that the lack of flow rate was due to formation damage. So we still think that's a very good play. Again, they found live oil. They've proven the petroleum system is working. They just need to be able to drill it without damaging the formation. So it's good data for us.
Any other questions? Gentleman there. Pass the microphone there. Will, I know you're a busy man. Are you very busy looking at M&A opportunities?
Yeah, I mean, one of the things about having sort of a very healthy balance sheet is you're sort of almost the prettiest girl at the dance. Everybody wants to dance with you. We're very focused on our current portfolio. We're very focused on trying to get these farm-in deals closed and get the Fumasaka option extended. We're hopeful we'll do that, but I think that there is a good chance that we might do some M&A activity in the new year. However, there's nothing currently which we are looking at, but there's certainly something which we would consider doing in the future.
And if the option doesn't continue, will you just walk away then completely, or there's an opportunity, do you think, to do some other deals in that area, or will you just move away completely?
Well, if we can't extend the option on Tendrara, we will
move
drop
away
it.
from Morocco.
Well, we will obviously still have our Fumasaka asset.
Yeah.
Yeah.
Thank you.
I just want to ask, we all hearing some bad news about the crisis happening with oil, gas in the other side of the world, like Middle East and Russia, and a few other refining, and at the same time a development of shale gas and future fuels, energy. I just want to ask, on your side, how careful are you on the future of sustainability on this production and defending your competitors around the world with this thing happening right now, and the price of Brent crude as well.
Yeah, I mean, when I started in the business, oil was at about $18 a barrel, and people were making lots of money out of it. Shell was doing all of their budgeting at $14 per barrel, so costs have undoubtedly come up. But I think there's a lot of projects, particularly in Morocco, where the assets are very economic. The assets that we've got, just looking at oil, because you're talking about oil price here, when you do the sensitivities that we've done, you tend to keep the costs the same, and you say, how hard do I hit this asset with the oil price before it doesn't start working? Well, as coming from a service company originally, when I was at Halliburton for 14 years, when the oil price goes down, the majors come to you and start saying, you've got to start cutting your costs. And invariably you do. It's just a sticky process. But when you do that modelling, you don't tend to assume that the costs are going to come down. However, if the oil price does come down to even $50 a barrel, I guarantee you that costs will also come down as well. And then the economics will then stabilise for that sort of environment. And I think one of the things that we're seeing at the moment is with the cost it is at the moment, the price of oil at the moment, you are going to see that a lot of countries are going to be hurting. The Russians are hurting at the moment. The Venezuelans are hurting at the moment. Arguably, the Saudis can't continue to operate at this price either. I don't think anybody really can for a sort of a government budgeting standpoint. And I think and there's a lot of different views here, but I think that the first thing to go was going to be the US shale. Shale oil does deplete very, very quickly. Shale oil, typically the break-evens are much higher. So in the US, oil has gone from 4.5 million barrels a day to 9 million barrels a day over the course of about 5 years. That's all shale oil. Assume break-even at sort of $60, $70 a barrel. A lot of that's going to come off, and the supply is going to drop straight off at the moment. Currently, the world's about $1 million barrels a day oversupplied. It's quite easy for that million barrels to go from shale oil, which is currently being shut in at the moment.